Welcome back, everyone. Today, we're doing a deep dive, a really practical explainer on exactly how you can navigate and honestly even benefit from the upcoming 2026 tax code changes. Whether you're an individual investor just trying to protect your hard-earned wealth or a business owner looking to optimize things, we're going to demystify exactly what this 2026 tax landscape means for your bottom line. We've taken all the heavy lifting out of it, pulling together insights from top CPAs and financial experts so you get the clear, actionable takeaways. Let's get started.
Okay, let's dive into this. Here's our roadmap for today. First, we'll hit the 2026 tax checkpoint, then we're navigating capital gains, moving on to updates for business owners, and we'll wrap up with strategies to save.
Section 1, the 2026 tax checkpoint, establishing your baseline.
So, you might be wondering, why is 2026 such a big deal? Well, let's look at this number right here, 2.3% to 3%. According to IRS Revenue Procedure 2025-32, the IRS is actually bumping up most tax thresholds by roughly this amount for 2026. And you know, this isn't just some boring technicality. It's absolutely crucial because it's designed to protect your purchasing power. It guards against what we call bracket creep. That's when inflation essentially pushes you into a higher tax bracket, even though in reality your actual spending power hasn't changed one bit.
Now, this all fits into a much broader legislative timeline kicked off by the One Big Beautiful Bill Act, or OBBA, which was signed back in July 2025. This sets up a very specific trajectory, especially when we talk about the state and local tax, or SALT cap. Take a look at how the SALT cap actually rises to about $40,400 in 2026. Then it stays indexed for inflation until 2029. But here's the kicker. Under current law, it drops sharply back down to just $10,000 in 2030. Oh, and a quick heads up. For taxpayers with a modified adjusted gross income over roughly $505,000, that SALT benefit starts to phase down. Understanding this exact timeline, it's basically your crystal ball for forecasting your state and local tax liabilities over the next few years.
Section 2. Navigating Capital Gains. How Patience Pays Off.
And this brilliantly illustrates the stark contrast between short-term and long-term gains. It's literally a night and day difference. If you sell an asset after holding it for a year or less, boom, you trigger short-term capital gains. Those are taxed just like your ordinary income, which can go all the way up to 37%. But if you just hold out, wait until day 366, you cross over into long-term capital gains territory. And suddenly, you're looking at highly preferential tax rates of 0, 15, or 20%. So yeah, patience here pays off in a huge way.
Let's actually break these rates down to see what they mean for you. Say you're a married couple filing jointly. You can have up to $98,900 in taxable income and pay absolutely 0% on your long-term capital gains. Nothing. And even if you make up to $613,700, your rate is still just 15%. For the vast majority of you watching this explainer, this long-term capital gains rate is going to be significantly lower than whatever your standard income bracket is.
Okay, but wait, we do have to add a quick caveat specifically for our high-income earners. Keep this 3.8% number in the back of your mind. Depending on your income level, you might also get hit with an additional 3.8% net investment income tax on those gains. So just when you thought you were totally done doing the math, the IRS throws in a little extra layer of tax that you absolutely need to factor into your sale projections.
Moving right along, Section 3, Updates for Business Owners, LLCs, S-Corps, and Partnerships.
If you're an entrepreneur, you're going to want to pay close attention to this one. Chief among your tax-saving tools is the Section 199A QBI deduction. Now, the actual legal tax code definition for this is, well, wonderfully dense. I mean, why make it easy, right? But we can translate that into a super simple rule of thumb. Thanks to the OBBBA, this is now a permanent provision. Think of it as basically a permanent 20% discount on your taxable business income if you're an eligible pass-through entity. It is without a doubt one of the single biggest tax advantages available to small business owners right now.
But, of course, there's a catch. This specifically applies to what the IRS calls a specified service, trade, or business. So think law, accounting, medicine, or consulting. For single filers, this incredible 2026 QBI deduction starts to phase out once you hit around $203,000. For married folks filing jointly, it's right around $406,000. So if you're in a service-based business, you've got to watch your income closely. If you creep up past those limits, you could accidentally lose that amazing 20% deduction, and nobody wants that.
Now let's pause for a second. I want to ask you a crucial question, kind of like a CPA would if you were sitting across their desk right now. What happens to your bonus depreciation in 2026? Because if you're planning on buying heavy equipment, fleet vehicles, or maybe some massive software package for your business, the rules are definitely shifting.
And the answer? 60%. Bonus depreciation is continuing its scheduled step down. So for qualified property that you place in a service during 2026, you can write off 60% of the cost in that very first year. Don't get me wrong, it's still a fantastic benefit, but it is noticeably lower than the 100% we've enjoyed in the past. That means timing your really big business purchases is quite literally more vital than ever.
But here's some good news to supplement that. The Section 179 expensing limit actually goes up to roughly $1.32 million in 2026, and the phase-out doesn't even begin until you hit $3.29 million in qualifying purchases. So as a business owner, what's your play here? You'll want to evaluate these limits and maybe even accelerate some of your equipment acquisitions. If you combine Section 179 with that 60% bonus depreciation we just talked about, you can still maximize your first-year write-offs and create some massive cash flow flexibility for your business.
Now, looking at things from an entity-level strategy, the corporate tax rate is actually holding incredibly steady at a flat 21%. Because of this, a lot of LLCs and S-Corps might really want to sit down with their advisors and rethink their entity structure. As other tax provisions start to sunset or change, running some scenario models might actually show that switching to a C corporation structure produces way better after-tax cash flow for your specific situation in 2026. Definitely something to look into.
And for our pass-through owners living in high-tax states, oh man, here is a total game changer. Currently, 36 states permit what's called pass-through entity or PTET taxes. Basically, this allows owners to bypass that $40,400 federal SALT cap we mentioned earlier. How? By paying the state income tax at the entity level instead. If you coordinate these PTET elections with your QBI deduction, you can yield a massive 4% to 5% in effective tax savings. That is huge.
All right, moving into the final stretch. Section 4, Strategies to Save, your 2026 playbook.
Let's talk about a really highly effective tool for sheltering those investment profits: tax loss harvesting. If you haven't heard of this, it's basically a strategy where you intentionally sell off your underperforming investments at a loss. Why would you do that? Well, you take those losses and use them to offset your realized capital gains. And it gets better. If you have excess losses left over, you can use up to $3,000 of it to offset your regular ordinary income and then just carry the rest forward to use in future years. It is an unbelievably powerful way to take a loss in your portfolio and flip it into a direct tax advantage.
So the crucial point here is you've got to play by the rules. You need to beware of the 30-day wash sale rule. If you sell an investment at a loss, but then turn around and buy a substantially identical investment within 30 days, either before or after the sale, the IRS is going to completely disallow that loss. You really have to wait out that 30-day window to make this tax loss harvesting strategy actually work for you.
All right, let's pull all this together into a 4-step, highly actionable playbook. Step 1. Always maximize your tax-advantaged accounts, and definitely explore those Secure 2.0 retirement credits if you're a small business. Step 2. Actively manage your portfolio and harvest those tax losses before the year ends. Step 3. Sit down with your CPA to review your entity choice and ensure your salary is set up perfectly for the optimal QBI deduction. And finally, Step 4. Reassess your state SALT and pass-through entity tax strategies. Honestly, treating these steps as one big, coordinated, multi-year plan, that is how you truly win at this game.
Which leaves us with just one final, really important question. Is your 2026 tax strategy ready? Look, these tax code adjustments are already in motion. Do not wait until April 2027 to figure out what you owe. Use the structured info we went over in this explainer today. Take this exact playbook straight to your financial advisor or your CPA and get started on your proactive planning right now. Thank you so much for joining me today, and as always, keep learning.